Hello everyone, my name is Swapnil. This is Toshit.
Welcome to this breakdown of a real world business case. And trust me, it's one that a lot of companies struggle with.
Imagine running a massively successful entertainment company. Shows are packed, revenue is booming, but when you check the books, the profit is just not growing.
In this video, we'll unpack what's happening behind the scenes. We'll look at where the money is going, what's dragging down the margins, and what the company can do to fix it fast. So let's start with the big picture. Over the last 5 years, this touring entertainment company has seen consistent revenue growth. Ticket sales are strong, show demand is rising, and new markets are opening up.
But look closer and there's a disconnect. Despite all that top line success, profits have barely moved. In fact, profit margins have stayed flat even as more money flows in.
That's not just a financial issue, it's a strategic one as well. Because if more revenue doesn't lead to more profit, it means the business model isn't scaling well.
And that immediately tells us this isn't a revenue problem, it's a cost problem. So, coming forward, we'll focus entirely on where the company spending is going and why it's not translating into profitability.
Let's break down the latest year's cost. This pie chart tells a very clear story. The biggest slice, the artist fees, rupees 125 crores. That's 40% of the entire cost base. It's understandable big partner acts pull big crowds, but they also demand big payouts.
Next, you've got production 90 crores or 29%. This includes everything from stage design to sound, lighting, crew, and special effects. Then comes marketing at 55 crores, 18% of total costs. Combined, these three alone make up nearly 90% of all expenses.
So when profits are lagging and these areas are growing fast, we know exactly where to look.
Here's the real problem not just the size of the cost, but their growth. In 5 years, revenue grew from 310 crores to 440 crores. That's about 42%. But look at artist fees. They jumped from 90 crores to 125 crores, nearly 39%. Production costs, same story. Up from 65 crores to 90 crores, a 38% increase.
It's not that costs are out of control, but they're creeping up right alongside revenue, which means profit margins are stuck. The company earns more, but also spends more at the same rate. That's why the bottom line isn't moving.
And that's the key insight here. If revenue and costs are growing together, the company is basically running on a treadmill, moving but not getting ahead.
So we asked, what's actually driving these costs? Let's break it down. First, artist fees. They have been rising year after year. Big names demand big payouts, and with touring demand at an all-time high, the company is paying premium rates.
But it's not just about market rates. A lot of contracts are fixed, meaning the company pays the same fee whether or not the event performs. There's no cost risk balance.
Then you have got production. These aren't plug and play shows. Every event is custom, new sets, special effects, complex staging. That's expensive, and they are not even reusing assets, which means high cost, one time cost again and again.
Lastly, marketing. They're spending heavily, but without a feedback loop. No one's tracking whether a campaign actually leads to ticket sales. So there's a lot of guesswork. So, what would we do differently? Let's start with artist fees. Instead of flat, high stake contract, move to performance based deals or revenue sharing models. That way, artist pay scales with the event success.
Exactly, it gives artists skin in the game and protects the company's margin on unperforming events. Next, production. The answer isn't to cut quality, it's to reduce variability, standardize key show elements, create reusable set components, and use modular design systems.
That brings costs down without hurting the audience experience. Finally, marketing. Bring in digital performance tools, track conversions, map ticket sales to campaigns, and kill the ones that aren't working.
It's not about cutting spend, it's about making every rupee accountable. If a campaign doesn't convert, it shouldn't continue. Alright, so let's say we actually implement those fixes. Performance linked artist fees, reusable production assets, and smarter marketing.
Here's what we get. Revenue keeps growing because the demand is strong, but costs start to grow more slowly. Even shaving off 3 to 5% in annual cost growth makes a huge difference.
Exactly, that small gap between revenue and cost growth. That's your profit margin. Coming back, it compounds over time.
And it's not a one time win, it's a structural change. You're building a model where profits scale with growth, not get swallowed by it.
And this also gives breathing room to reinvest in better shows, bigger venues, or even tech upgrades without killing the bottom line.
This case taught us something simple but powerful. Just because your revenue looks great doesn't mean you're actually winning.
Yep, the real win is in what you keep, not just what you earn. That's where profit comes from cost control, smarter operations, and scaling the purpose.
So, next time you hear someone say revenue is growing, so we are fine,
Ask them one question, yeah, but how much are we keeping? Thanks for watching.
if you like this breakdown, give us a thumbs up and we'll see you in the next case.